Research at City, Markets Edition.
Welcome to Research at City, Markets Edition, where we break down global macro in 10 minutes. I'm your host, Beata Manthey, Citi's Head of European Equity Strategy. Joining me today is our Senior Equity Strategist, David Groman. Welcome to the show, David.
Thanks, Beata. It's great to be here. And obviously, we got a lot to discuss as well. Equity markets back up near all-time highs, but also plenty of questions about whether or not we can still see more gains from here.
So let's dive right into it. On one hand, we are seeing persistent macro headwinds, tariffs, potential slowing in the US labor markets. But on the other hand, we have the prospects of the Fed cuts, which are providing a strong tailwind. How do you see these forces playing out in the current environment?
Yeah, it's a tricky environment for investors. And I guess maybe before we go into what's next, it's useful to kind of take a step back and look at where we've come from. So I think actually what's interesting to me is how little differentiation we've seen in performance between regions this year, right? All major markets basically seeing pretty solid gains. But underneath the hood, you've seen pretty big divergence in terms of sectors and themes, many of which are significantly outperforming. And even within regions, we've seen some differentiation, right? So in the US and in emerging markets, it's been large caps and growth stocks that are doing better. And then in Europe and in Japan, it's been value stocks and small and mid cap stocks that are leading the way. So really a different picture looking across the globe, despite the fact that we've seen gains.
So that's precisely in line with the way we are thinking about global equities right now. So we have themes or sectors over the regions. But whether it continues really depends on the macro backdrop. So let's talk about the Fed easing a bit more, especially as we are awaiting their decision later this week. How could it impact the market dynamics from here?
So yeah, in a soft landing scenario, which is really with the Fed cutting, but also US economic data and global economic data continuing to hold up, I think that could be a reason to think that broadening dynamics really will take hold within equity markets. And by that I mean that we could see cyclical markets, including those outside of the US outperforming. We could see value stocks outperforming their growth peers, and also seeing those small and mid cap stocks continuing to do well versus their larger cap peers as well. And really, that's what we've seen historically when we look at the data, is that the start of Fed easing cycles really tends to be a catalyst for these broadening moments. I think the main question for us and for many investors is that we've already seen pretty bullish dynamics take hold within equity markets since the Fed started cutting just about a year ago. So that raises questions as to how much has actually been priced in already.
Of course, and what I would add to that is also the fact that European equities have had one of their best ever runs of performance since the Fed actually started easing a year ago. But that's the positive story. How about the other side of the coin? So if the economic weakness persists and actually even deepens, how might that shift investors' focus and what would be the city's playbook be then?
Yeah, so in that scenario where we get a little bit more of a slowdown, I think that you might see this return to a what we like to call a growth is defensive playbook, where investors flock back into larger cap, higher quality stocks for safety. And I think in our view, where we're settling is that we kind of split the difference between these two extremes, right? The soft landing and more of a slowdown scenario. And because of that, our global equity strategy maintains more of a cyclical tilt, but we are coupling that with a growth bias, especially in the US. And really, I would just summarize that as if you're going to look for cyclicality, look for that outside of the US, but still take some growth out of the US market itself.
Interesting. Okay, so it looks like the menu of the themes or markets to pick from potentially is getting bigger. Nice. But let's pivot to earnings right now. So consensus is projecting about 9% EPS growth this year, with Europe actually flat, and then stronger growth globally, 12% next year, Europe coming in at 11%. So these are decent numbers. But we've also seen EPS estimates consistently revised down across many regions around the world earlier this year. Let's talk more in detail about these issues.
Yeah, so there's actually some good news there, which is that if you look at earnings estimates really across the world, we've actually seen some stabilization in those downgrades, and we've actually even started to see some upgrades coming through just over the past few weeks, and that is especially the case for the US market. When it comes to Europe, looking forward, we'd actually say that there is a chance that you could start to see some of these upgrades filter through over the next few weeks and months as well. And there's really a few reasons for that. Two of them that I would highlight. One of them, according to our models, it seems like European earnings forecasts where they are now probably embed risks of 20% US tariffs, which is a little bit higher than the 15% tariff rate that we ultimately settled at. And again, on the tariff front, there's some interesting data that's showing that US import prices or export prices for companies outside of the US haven't really fallen off in any meaningful way, which means that it doesn't look like exporters are cutting their prices when selling into the US market. And that might mean that margins for ex-US businesses could be a little bit more resilient than maybe some investors had feared coming into this year.
And how about the valuations?
Yeah, so they are looking increasingly stretched, and I think that is a point of worry, right? So if you look at the US market, for example, it's trading at a 12-month forward PE ratio that is at, I think, a 99th percentile versus the past 20 years of history. And even in continental Europe, which is a market that people tend to think of as cheaper, is trading at a 70th percentile valuation multiple versus its history. So I think it's hard to say that equities, at least at the index level, are cheap at this point in time.
Interesting. Of course, that implies that any upside from here is capped by valuations if the EPS doesn't deliver on these expectations. And just to put it into the context, in terms of our targets globally, we see decent upside into the mid next year. However, it's pretty limited when it comes to the end of this year. But David, let's turn our attention to Europe now. So Europe has done very well this year, especially Germany via the defense of infrastructure spend. And then we have Spain that has done super well via banks. And now banks themselves are up 47% year to date, right? While the major laggard sector in Europe, luxury goods, is down 10%. So it really plays into what you've described before, that all the alpha has been more on the sector levels right now. So on the European view overall, we've maintained our overweight call on the region, but it's becoming a bit more nuanced than before, especially given the recent political developments. Can you walk us very quickly through your concerns or no concerns around French political situation?
Yeah, so I think there's things to be concerned about when it comes to France. Obviously, we've had this set up really over the past year that's characterized by political instability, by policy opacity, and I don't think that that sort of dynamic is going away anytime soon. But at the same time, I think a lot of this political uncertainty is probably captured in the price of French equities at this moment in time. And really, when we look out at the French political situation, unless there's a snap election, which maybe could lead to something like a 5% derating in French equities, we think that most of what we've been seeing is probably already in the price. So, not that it's a great setup here, but I do think that there is some nuance and it's really a mixed bag when it comes to France. But at the same time, I think to turn this coin back on you, obviously we have some of these uncertainties coming from France, but how do you weigh that in sort of the broader view on Europe and the overweight call, obviously, that we have on that market?
So we get that question a lot, as you can imagine, but it is very important to distinguish that the case for Europe has always been about German fiscal spend. And to us, it's intact for now. If anything, it's continuing to surprise to the upside for the time being.
Yeah, and I think that's really interesting. So, I mean, how would you talk about some of these upside surprises on fiscal stimulus that you're talking about? What do they look like, and what are the implications here?
Absolutely. So we've seen larger than expected NATO commitments coming alongside the rollout of swifter and more sizable German spending. And all this actually is starting to evolve private sector participation, which should be also key going forward. So this is a significant development and a key reason for our broader European conviction.
Yeah, and just to kind of bring this even more granularly into the equity market space, like what did these things, these policy changes actually mean tangibly for corporate earnings and then therefore maybe valuations as well?
So, first of all, they should imply higher GDP. Higher GDP should imply higher EPS growth. According to our models, we could get around 3 percentage points higher EPS per annum over the next 5 years. So that's decent upside. And historically, higher growth have been implying higher valuations, therefore our bull case and the potential for some more rating for European equity markets from the current levels. Now, the biggest beneficiaries within the market, very simply, cyclicals, value, and mid caps.
Yeah, it sounds like a pretty powerful tailwind to me. And at the country level, are there any main beneficiaries that you're looking at?
Well, definitely, and obviously Germany stands out as the primary beneficiary from both the domestic spend and also the EU spend. So analysts, together with our top-down models for upside for earnings, suggest that we could get 15% EPS growth per annum from Germany by 2029. Now, that's higher growth than the US is offering right now and is coming at a 7 PE points lower valuations. What's not to like?
I mean, I'm convinced. And I think really the implication there is that all of this that we're hearing about on the fiscal side of things, it's not fully priced in, it's not fully reflected yet in European markets, in European valuations. So potentially more to go in terms of the fiscal story. And yeah, I'll just say thank you again, Beata, for that comprehensive outlook on the European story. But just want to take a step back and maybe summarize some of our global views for our listeners here. So one, we are navigating a market that is at or near all-time highs. We are balancing those macro concerns, primarily from things like tariffs, against the tailwinds that are coming from Fed easing. Our global equity strategy, it maintains a cyclical tilt globally with a growth bias in the US. And when it comes to Europe, yes, there are some political uncertainties in France, but there's still a really strong story there coming from the fiscal side of things, which in our view justifies that broader overweight. So, Beata, I'll turn it back to you again. I mean, what is one main takeaway that you would leave our listeners with here today?
It really has to be keeping a close eye on the EPS delivery, given the current valuations constraint and how this European fiscal dynamics continues to play out. So clearly, plenty to look out for, but I think it's time to wrap up here for today. David, thank you very much for being with us.
Yeah, my pleasure. Thanks for having me, Beata.
Thank you for joining us today. This episode was recorded on 15th of September 2025, and I'm your host, Beata Manthey. If you enjoyed the podcast, please leave us a review on your favorite podcast platform. Our next Research at Citi Markets edition will be hosted by Dirk Willer, Citi's Global Head of Macro. Thanks for tuning in. Goodbye for now.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyrights 2025 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.